Good afternoon, everyone. My name is Chow, and today I'll be presenting topic 3, which is the collapse of Silicon Valley Bank. So, for my content table, I'm presenting three different parts. The first part will be the introduction of Silicon Valley Bank. Silicon Valley Bank, which was founded in 1983, was headquartered in California, Santa Clara, the heart of Silicon Valley. It was labeled the 16th largest bank in the United States before it eventually collapsed. Moving on to the customer base, Silicon Valley Bank provides banking services personalized for high-growth companies like venture capitalist startups and are usually favored over other banks because other banks aren't willing to assume the credit risk that these companies might face. And thus, over 50% of startups in the United States are using Silicon Valley Bank as their banking solution. However, one important note to take that is these startups are predominantly high-risk clients because they usually operate at a loss for the first few years and are highly dependent on venture capital investments, which will be a crucial risk in the following slides. Following on the bank's internal structure and work culture, they operate with a flat hierarchy whereby there aren't much levels between the management and staffs and encourage to voice their innovative ideas, which is often unseen in a traditional bank. The company also promote remote working to embrace the work-life balance as evident from their executives being located all over the world. Looking at the macroeconomic environment, the Fed introduced new enhanced prudential standards due to weak policies that resulted in the 2008 financial crisis. And these policies are required by large banking corporations managing over $50 billion in US dollar to comply with rigid stress testing measures and risk management procedures. However, changes were made in 2019, whereby the minimum total asset managed shifted from 50 billion US dollars to 250 billion US dollars for a large banking corporation. And this resulted in Silicon Valley Bank not requiring to follow the strict procedures for stress testing, which could be another issue that led to its eventual downfall. Moving on to part 2, whereby I'll be talking about the key risk drivers that stress Silicon Valley Bank. Firstly, we'll be focusing on the concentration risk on their customer base. Since the majority of their customers come from one region, Santa Clara, and is highly concentrated in two industries, technology and healthcare. It could create an issue for the bank due to the lack of diversification in its customer base, as the bank might be highly exposed to economic conditions. So, for example, if the economy experienced a recession or a slowdown in venture capital investments, it could heavily impact their only customer base, which could reduce banking activities and could potentially decrease the bank's potential profits. Secondly, we'll be focusing on a concentration risk faced by the bank's asset. So approximately half of the bank's assets are invested in long-term held-to-maturity bonds with an average maturity of 6.2 years, and mortgage-backed securities with an average tenure of 10 years or more. And investing majority of their assets, which are mainly customer deposits, into securities that are highly sensitive to interest rate fluctuations, runs the risk of being unable to liquidate their asset easily or face selling asset at a loss during an interest rate hike. So one key issue And one key issue that could cause such mismanagement of risk is due to the lack of risk management expertise, which falls under operational risk. Within the 7 members of the Board of Risk Committee, only one individual had prior experience in risk management. And this issue was rather worsened by the fact that the chief risk officer role was held empty for 8 months throughout 2022. With the lack of expertise and a major leader to oversee the risk management practices, such as the lack of stress testing, this might have caused several risks to be overlooked. And which interest rate risk was one factor that the risk community overlooked. So in 2022, the Fed increased the interest rate significantly to combat high inflation, raising the interest rate from around 0% to over 4% within the span of 1 year. This increase affected the broader economy, particularly impacting high-growth companies like those in SVB client base, as they face significantly higher borrowing costs. Similarly, the portfolio of Silicon Valley Bank, which is predominantly in bonds and mortgage-backed securities, was significantly affected. So as this created liquidity risk for Silicon Valley Bank clients, investors made a switch to bonds, which were low risk and with high returns, resulted in lesser investment made into venture capital firms. As proven by the decrease in deal count in start investment, Silicon Valley Bank customers, who are startups, faces low inflow of investments and high cost of capital, had to resort to withdrawing their deposits to fund their own operations. Sequential withdrawal of bank deposits place tremendous pressure on the bank as they do not have sufficient liquid assets to actually keep up with the withdrawal rate. Since almost half of the bank's asset is tied to long-term bonds as well as mortgage-backed securities, what did the bank do? In this scenario, it created a significant market risk by selling a 21 billion US dollar bond portfolio, realizing a loss of 1.8 billion dollar. And still didn't have sufficient assets, so they initiated a common stock sale plan which massively diminished their reputation as a financially solvent bank, which further heightened the bank's reputational risk since the majority of their clients come from one region. Word regarding the financial troubles the bank faces were widespread on social media. Everyone was fearing that the bank might end up insolvent, and customers rushed to withdraw their funds, resulting in a bank run. Fueled by panic, investors also sold off their shares, causing the share price to tank by 60%. At the end of the day, almost $42 billion was withdrawn from the bank, exacerbating its liquidity crisis and leaving the bank insolvent with $1 billion in negative cash balance. So for the last part, I'll be talking about the fun facts of Silicon Valley Bank. After they were stated to be insolvent, First Citizen Bank actually took over and acquired Silicon Valley Bank, and all clients' account, loans, deposit will be transferred into First Citizens Bank accounts. And they also became a division bank whereby they were able to operate on their own name, but the operation will be managed by First Citizens. Thank you.